Miss Tina Mitchell with Highlands Mortgage. We asked her a couple of questions. The first one was, what are you passionate about outside of business? Her answer was, I love canasta, puzzling, and color booking. I also love to travel, listen to music, camping, and everything nature. I just upgraded my pop-up tent trailer last year, and I've already went camping this year 7 times. That's awesome. I've actually been camping with you. The second question was, share a little bit about your family. She has her answer. I lost my dad in 2004, but still have my mom and spend a lot of time with her and my little sister. The 3 of us take train trips to Portland, usually 2 to 3 times a year. We just took a train trip in October. I also have game night every quarter with my mom, sister, and her family, husband, and my niece and nephew. Dave, her husband, and I have also have our first grandchild, Colina, that we get to babysit every Friday. Thank goodness Dave is retired, so I can still work on Fridays, but I don't take any appointments except for client consultations after 6 p.m. Fun fact, her name, Colina, is a mix of her parents' names. Colt is her dad and Serena is her mom. So that's how they came up with Colina. And she's adorable. And the last question that we asked her, what would your entrance theme song be? And not surprising, she wrote the Rocky theme song. So welcome, Tina Mitchell.
Thank you so much, Leslie. I actually should have played the Rocky theme song if I had more than 10 minutes, which I do not. So I wanted to give a share here of historical interest rates. So these are rates from 1971 to 2020. In 1971, the same year when Freddie Mac started serving lenders 30-year fixed rate mortgage, hovered between 7.29 and 7.73%. Now, the average, or the annual average rate of inflation, began rising in 1974 and continued through 1981 to a rate of 9.5%. Now, as a result, lenders increased rates to keep up with unchecked inflation. The Federal Reserve combined inflation was increasing the federal funds rate, or the overnight benchmark rate, to the banks that they used to borrow from each other. Continuing hikes in the Fed funds rate for the 30-year fixed mortgage rates took them to an all-time high of 18.63% in 1981. Now, eventually, the Fed's strategy paid off and inflation fell back to normal historical levels in October of 1982. Home mortgage rates remained in single digits for much of the next 2 decades. Now, mortgage rates tend to continue to decline, or continued to decline. Rates dropped to 3.31% in November of 2012, the lowest level in the history of mortgage interest rates. Now, to put into perspective, the monthly payment for a $100,000 loan at the historical peak rate of 18.63% in 1981 was $1,558 compared to $438 at the historical low rate of 3.31% in 2012. Now, today, the current 30-year fixed rate is 3%, and that increased from the lowest ever on record of 2.25%. Now, the increase that we've seen in a short period of time is because of inflation. Inflation is the arch enemy for mortgage rates. So the definition of inflation is, simply put, that inflation is increased cost for goods and services. What cost you $100 to purchase may now cost you $105. The value of the dollar is worth less, so it takes more dollars to purchase those same goods and services. Higher inflation is bad for the bond market. And when bonds drop, the Fannie Mae 30-year bond drops, mortgage rates are directly tied to it, so they'll increase. Now, you can watch the Consumer Price Index CPI and the Producer Price Index PPI, which measures inflation. CPI, the Consumer Price Index, is the cost to consumers for goods that they pay at the store. The PPI, Producer Price Index, is the cost wholesalers pay for their goods. Now, when the PPI goes up, wholesales price goes up, so they can make less, or what they do is they pass it on to the consumer instead. A higher CPI and PPI means inflation, and bad for mortgage interest rates. So imagine if you were going to lend your own money for someone to buy a house. The bank's payments start coming in at $1,500 a month. That $1,500 used to pay for cost to run the company. Now, over time with inflation, every month the bank is getting less for that same $1,500 because the cost has rose because of inflation. So due to inflation, the $1,500 a month is worth less. As a result, you will need to charge a higher interest rate to compensate for the impact of inflation. This is why mortgage interest rates increase with inflation. Now, the Fed's target for inflation is 1 to 2%, but when budgeting for the future, most advisors in the financial space will estimate about 3% inflation to determine for future living cost. Today, inflation is at 5.39%. So who benefits from higher inflation? Homeowners benefit from inflation because the money that they pay back, their fixed rate mortgage, is worth less today than it was yesterday, but it's fixed. The higher the inflation rate, the sooner that your home value doubles based on the rule of 72. So home prices usually rise with inflation. As the value of the dollar is worth less to higher inflation, it will take more dollars to purchase that same property. So real estate traditionally works well for a hedge against inflation. Your home increases in value will offset some of the inflation. There are only a handful of things that you can hedge against inflation: real estate and gold, assets that will inflate at the cost of everything else going up. So I want to show you a fun example, and I call it my inflation water ball example. So let me move my camera down a little bit here. Okay, so this is the inflation water ball example. A home right now would cost you 4 water bottles, and your income, you make 4 water bottles. So today, out of that income, you have 2 that are going to go towards expenses, 1 towards savings, and 1 towards discretionary income. Well, inflation goes up, that cost of your home is now costing 5 water bottles, but you only are still making 4 water bottles in your income. So you have no discretionary income, but you're financially responsible. So you take 1 of those and put it towards saving. The other 3 are going with the inflation. The cost of your expenses go up 1 water bottle. Now we move to another year. Now that real estate costs 6 water bottles, you're still only making 4 water bottles of income. Your expenses go up because of inflation, and it's costing you everything that you're making to live. So you have no savings and you have no discretionary income. Now, if you're a homeowner, nothing changed with your income, but your real estate increased by 2 water bottles. So you're not able to save here, but you have what I like to call your home savings account, which is the appreciation on your home. So you can see if you don't own a home, you have nothing to save, you can't keep up with the fact that home values are increasing. So that's what it looks like when you do not own real estate, and why it's important to get into home ownership. Now, as I'm wrapping up my time for my last 3 minutes here, I want to talk a little bit about mortgage interest rates, because lenders can choose to pay millions in advertising, or they can choose to build relationships offering a more competitive interest rate. So you may hear a lot about Quicken Loans. Quicken Loans being known as having better interest rates per their ads. Well, let's go ahead and take a look at Quicken Loans right now today. So if we look at their website, they're advertising a 3.125% interest rate. Now, if you take a look at, make sure I'm shared here. When you take a look at their disclosure, because the APR is 3.381%, here's their disclosure. To get that 3.125% interest rate, you're going to pay 2.125% in discount points. That's what it costs to get 3.125. Now, if I show you our interest rates right now today, they were using a loan amount of 200,000, which is just under 25% down because it's a better interest rate just under 25% down. Highest credit score. So at 3.125, which at Quicken cost you 2.125% in interest rates, if you were locking in for a 30-day, 100 means zero discount points. So if you take 100 minus the 99.625, it's actually going to only cost you with Highlands residential mortgage 0.375 in discount points. That is a difference of $3,500 in savings in that discount point because the loan amount's so low at 200,000. Now calculate that if you're buying with a loan amount of 500 or 700,000. Now also you can take a look at what you could get in an interest rate closest to 97.875 because that's what you would be looking at with a discount point of 2.125. Closest to that would be a rate of 2.75. So our interest rates are 2.75 versus 3.125, or you're going to pay $3,500 less in closing cost. So that's the difference between what might be known as a discounted shop, but not, because they're spending their resources $1 million into advertising. Now, there are discounted shops, they're not spending millions on advertising, but they're also not spending resources on providing a high level of service. Please remember that discounted shop equals discounted service. Price or service, which one would you choose? Well, if you're purchasing a home, you want to choose a high level of service, and at the same time, you can get a competitive interest rate. My name is Tina Mitchell. I'm your local mortgage consultant, over a quarter century in the mortgage industry, helping families with home mortgages. All right, let me go ahead and stop recording.